Earlier today, in a bid to keep the Australian economy running, the Reserve Bank said it was ready to announce further policy measures and to pump more money into the financial system. Well, what does all that exactly mean? Joining me now, former Chief Economist of the Prime Minister and former Reserve Bank official, Dr. Andrew Stone, is with us in Sydney.
Hi, Peter.
Andrew, just talk to me. Thank you for coming on. Just talk to me about the market. What's making the market moves? Is it predominantly speculators looking to offload or profit from the turbulence of coronavirus across, market sectors like tourism and airlines, or is it something more?
I'd say there will be a certain amount of that, but it's also that profoundly there is tremendous uncertainty about how this will play out and how deep the short-term economic damage will be. As you stressed in your opening, we will get over this, and whether it's 3 months or 6 months or 12 months. But in the short term, there will be some particular sectors, especially, that will be very badly hit. And so it's understandable when there's a lot of uncertainty, people may behave defensively, they may wish to get out of the market quickly. I think it's not necessarily that meaningful to focus on those market moves, though, in terms of what the economic impact will be. It's maybe better that the market is struggling to get to grips with what that will be just as much as economic forecasters are. So it may be better just to focus directly on the economy.
Andrew, we know that the Prime Minister, the government has signalled they're looking at a second stimulus package. Before we get to that, and we think that package will be really pushing hard at industry and workers, before we get to that, we could talk then about the RBA and its various levers. What can the RBA do from here?
Well, actually, they've made some announcements today, which I think were sensible housekeeping. Primarily, it's just designed to ensure that there is liquidity available to banks so as to minimise the chance that banks compound the problems that small businesses especially, but other larger businesses will be facing. Because there will be businesses that face a big downturn in demand, especially you're mentioning movies, cinemas, small businesses, restaurants and so forth, they will face difficulties, and the issue is to try to help banks. It will be the interest of banks to try to avoid ever foreclosing on loans for those businesses which may be fundamentally sound and just facing a big cash flow problem. Whatever we can do to try to help that is helpful also from a financial market perspective in terms of assisting banks to avoid doing that. And that's what the Reserve Bank has done today. It's announced essentially that banks that are having difficulty getting cash because perhaps the people who they've made loans to are not paying them back as quickly as they should be, banks will have access to capital. They can take some of their assets to the Reserve Bank, and the Reserve Bank will lend to them for 1 or 3 or 6 months on the basis of that collateral, just to help tide them over any difficulties that they might face with cash flow, so as to minimise the flow and impact to businesses.
And just quickly before I go, bonds and quantitative easing, tell us more.
That's where I am. I confess my view is I'm hopeful the Reserve Bank doesn't go down that path. I actually view what the Reserve Bank's done today as helpful, but I actually didn't support their cut to interest rates to 0.5%, precisely because I'm not sure what that's going to achieve. I think the federal government's stimulus package was quite well directed, most of the components of that quite well directed to the particular problems, which are fundamentally cash flow problems for businesses. To be trying to further drive down interest rates to support the economy at this stage, you've got to ask, what is the problem you're actually trying to address there? My concern is that it's not a fundamental problem of lack of demand, it's that we have this temporary interruption. It's not the fact that businesses are finding it too expensive to invest or whatever at the moment that's the problem. So I would not support if the Reserve Bank goes down that direction, but I suspect they may be going down that direction of trying to drive down even long-term interest rates so as to make it even cheaper to borrow.